As a business owner, when you're looking to grow to the next level or find a capital partner, what would you prefer? Should you consider venture capital or private equity? What is the difference? Today, I talked to a prospective client in the CPG industry. So here's what I would explain. First is that the stage is different. Private equity fund typically invest in a mature and established business. So they want to see stable cash flow for the past 3 to 5 years. And also they would look for like backward financials. And also they would see if there's any opportunity for them to create more value and turn around the situation or keep growing the company, scale it up more. And then eventually in 5 to 7 years, they plan to exit. So that's their model. But venture capital is different. They invest the early stage startup or smaller business, but they invest, their expectation is to grow 100 times, for example, versus private equity, their expectation is to grow 5 to 10 times. So next is that the percentage is different. Private equity fund, they typically want to take majority control. That means it's at least the 51% or preferably 100%. Venture capital is different. What they invest in is that they invest in a small stake. They don't take majority control. They're more like a silent investor. And but they expect a high return for their good investments. And then also the amount is different. Private equity, because they're buying 100%, their amount of investing is typically larger than venture capital. For example, they could invest 25 million, 50 million, or 100 million, but venture capital typically invest in less than 10 million or around 25 million or less per deal. But they invest in very many of deals that they select or they think will have the high potential to have high return, although the success rate is really, really low. So that leads us to the next point is the risk is different too. Private equity firms, because they invest in a mature company, right? So it's already proven. The model is already proven to be successful. They're just adding more value and trying to make it better and grow more. So for that reason, risk is lower for private equity fund than venture capital for sure. Venture capital fund has a higher risk because the business model is not proven yet, right? So it's still early stage. It is still a startup. Risk is very high per investment, but they make a lot of investments like that. The industry is also different, right? So for private equity fund, they usually invest in a more cash cow kind of industry, right? It's something that's already proven, something that has the potential to scale up to have 5 to 10 times the return, and then the private equity firms, they're happy. But venture capital are different. Venture capital, their industry sometimes could be very, very cutting edge technology, for example, something new in the internet space, in the technology space, or biotech, or some other very, very, very cutting edge technology. So it could be that this is really, really new. So, but the industries are kind of different. It really, once you have a unicorn, the return is very, very high. So that's overall the difference. So the prospective client asked me that as an M&A advisor, which one do you actually work more in? I have to say that we work more with private equity funds. So that's our model. So I have to say that if you have an earlier stage companies, it's better that you pitch directly to the VC fund and see if they're interested to have a conversation, maybe have a deal done. So, okay, that's it, what I want to share today. So this is Tina, and I'm the M&A advisor based in Southern California, and I'll see you next time. Thank you for watching. Bye-bye.